Hey folks, just a reminder, these trades are done in a simulator. It's important to understand the limitations of hypothetical results. Make sure you read that hypothetical risk disclaimer you see on the screen. If you have any questions about what it means, please feel free to contact us. You can email trade@infinityfutures.com with any specific questions. Thanks again. Hey everybody, this is Patrick Zielbauer from Infinity. Thanks for taking a look at the YouTube channel. So it's about 7:45 on October 29th in the evening. And I did promise that I would drive a lot of this YouTube playlist via questions that I get from customers. And I did get a few questions recently about option trading, and I wanted to share with you just a couple of points about futures options, why it's not as prevalent in the trading world as regular equity options, and also just a little bit of an example, I suppose, of why Infinity has such a steadfast belief in the simplicity of futures and why that's our focus, especially with some of the new contracts that have come out. So just in general, most people have noticed that the futures option world is just not as accessible typically to the retail customers as, say, equity options. So there's been a huge online self-directed trading revolution. The futures market is very much a part of that, as our equities, as our equity options. Options on Netflix and Microsoft and such. Not so much in the futures world. And the main reason I believe that is that clearing firms or FCMs who are acting as custodians of customer funds are just not very interested in letting people take risky positions, usually in the form of, for example, naked calls or puts or short strangles. They're not willing to let customers, or they don't want to encourage customers to take those sorts of trades because the return to the brokers in terms of whatever the discount rate is versus the risk of a potential catastrophe is just not worth it. So, as an example, there are well documented cases recently, you can Google it, about brokerage companies who are letting account managers sell natural gas calls, for example, and something happens, you get some sort of black swan anomalous type event, and it's very possible in those sorts of situations where customers end up owing the company money, their debit, their negative in their accounts. So that's a risk that you take when you trade futures. It's a risk that you take when you trade options. But when it comes to being short naked options, it's just not something that clearing firms are really interested in. It just is not worth the risk. So you tend to see companies sort of downplaying the access to the futures options market instead of encouraging it. Okay, so that is at the heart of the whole issue, I think, is risk. That's probably the biggest part of it. But there's also a complexity associated with the options world that I oftentimes see people trying to get really cute with, and there's lots of examples of people trying to create complex option trades, and there's lots of examples of theory that doesn't really hold true in the real world. And we see this in trading a lot, where people backtest stuff, or they go through hypothetical trades, or replay the charts, or whatever. And when it comes to the real trading environment, things just don't play out the way that they had intended. That could be a psychological thing. It could be the reality of, say, not getting filled on an order that you may have gotten filled on in your simulator. It could be a very wide bid-ask spread that you weren't counting on existing, anything like that. And there is something to be said about complex option strategies. I'm sure that there's a lot of people out there who have made money with some of these complex strategies, but we also believe that there is a simplicity associated with straight futures contracts that is unique. And especially with the new micro contracts that came out in May of this year, we do believe that it lends credibility to the idea of trading straight futures contracts, even in volatile markets, versus options. So the CME, the exchange, has definitely made a big push on these micro contracts as option-like in some ways. So why do people trade options? Well, some people trade options for the lotto ticket type trades. Okay, lotto ticket trade would be something like buying a out of the money, very close to expiration call on Netflix right before earnings, something like that, where you're going to pay almost nothing for it. And if they blow out earnings, and you have a chance at a 500% return or something like that. Okay, some people trade options for that reason. That is not, in my experience, the majority of people. The people that I talk to who are in the trading community are usually trading options because of the limited risk nature of options. Maybe they've been a little spooked by the idea of using futures because of leverage, or whatever, maybe they heard something from their uncle who traded lean hogs in the 80s or something like that. But with the presence of these micro contracts, you could almost argue, and the CME does make this case, that they are almost option-like because they're so small. So if you trade a micro E-mini S&P, which is like 1/10 the size of the regular E-mini S&P, you're trading a contract that's worth in the neighborhood of about right now, based on where the S&P is, about 140, 14 or $15,000, as opposed to 140 or $150,000, which is the size of the regular contract. So you're taking a position that is way, way, way smaller than the regular E-mini, where if you make a mistake trading one or two micros, it is unlikely to prove to be an absolute catastrophe. Whereas if you're trading the regular E-minis and you don't know what you're doing, or you make a mistake, or find yourself on the wrong side of something, or you accidentally hold a position over the weekend or whatever, and it opens against you, that could be an expensive lesson. So the case that the micro E-minis are sort of option-like in terms of just because how small they are, you could argue the limited risk side is a valid case. But the benefit is you don't get the negatives associated with options with the micros. So, or with the regular E-minis. You don't get the volatility crush that occurs after an economic report or earnings or something where the premium just gets sucked out of the option, right after you get into it. And you don't get that sort of annoying bid-ask spread deal where you're trying to wiggle your order in and it just never gets filled and you feel like someone's kind of watching you on the other side of it. And that's not something you typically see in very liquid E-mini index contracts, including the micros. So there are benefits associated with futures that don't exist with options, even futures options. And also there are tax benefits in the futures market over, say, equity options. So if you make money trading the E-mini S&P, there are tax advantages associated with that versus making money trading, let's say, the SPY in your stock account. There's no margin interest in futures. There's all kinds of reasons why you'd want to do it. But I found it kind of an interesting example that I wanted to show you about what I mean, sort of like with the volatility crush. So the chart on the left here is of the December 3000 E-mini S&P call. Okay, so this is a chart of an option price, not of the S&P itself. Okay, the chart on the right is the E-mini S&P on a daily time frame. Okay, so what I'd like you to do is look at this October 2nd candle. So this is the price of the 3000 call that expires in December on October 2nd. So you've got a range here from about 60-ish points, okay, to about 35 points. So if you look at the October 2nd futures candle, look here. So this corresponds with this candle right here. So as the market is falling, the price of the call is falling, which makes sense, right? Because as the market is falling, this premium is getting cheaper and cheaper because the likelihood now of this market hitting 3,000 is going down. So the premium is coming down. Okay? Makes sense. So let's just give you the benefit of the doubt and pretend like you bought this call at the low. So let's pretend you paid 36 points for it. 35.97. Let's just say 36 points. So you pay 36 points. Every point's 50 bucks. That's 1,800 bucks. So you say, you know what? This is a December option. I've got time. I'm going to pay 1,800 bucks for this call, and you take the trade. So you put this position on, and you intend to stick with it. All right. So let's just say that, again, hypothetically speaking, you buy the absolute low, which is obviously relatively unlikely, but for the benefit of, the option trader in this case, let's say that happened. So you put that position on. All right. Now let's say you let this trade run for a few days. So the next couple days, it's looking good. Okay. The market is rallying. The S&P futures are rallying back to 2950. You can see at the end of the second day, the S&P is back to 2950. Okay. And your option price has rallied all the way up to 56, relatively or close to 56. So you bought it down here at 36. You're up about $1,000 on it. That's great. Okay, if you would have bought the futures contract, you're up more. But let's just say you decide to do the option trade. Now let's say that the market starts to fall the next couple of days, which it did. On the 7th, it was kind of flat, slightly down. The 8th is where I want you to pay attention. Okay, so look what happens to the price of the call on the 8th as the market falls back down near those lows. So the market is coming down here. Let's say that you stop yourself out at the low of this candle. So you say, you know what? I was in this trade for a few days. It was looking good. I didn't cut it loose. I'm just gonna go ahead and close it out. And you end up closing it out near the low of the day. All right, that trade in the futures market is still a good trade. Look at the low of this candle on the 8th. It's about 28.90, 28.91. All right, so if you would have bought the futures contract on the low, you're at 28.74 and a quarter. And if you would have sold it on the low of this candle, you're at 28.90 or so. So that's about 16 points of profit. 16 points times $50 a point on the regular E-mini, that's $800 gain. So this trade is an $800 gain from here to here. But look at the price of the option, okay? You paid 36 points for the option. All right, the market rallied up, then it was flat, then it came down. Let's just say you sell the option on the low. So same timing on both of these things, right? There's no advantage I'm giving to one or the other. You sell that option on the low of the day, that's 34 and 3/4 points. You have taken a loss on that trade. So even though you're trading the same underlying index, what's happening here is as the market is falling, the likelihood of the market getting back to $3,000 or 3,000 points is obviously coming down, and that is working against you, as well as the fact that the option is decaying in terms of time value every day. That's called theta decay. So to me, this is a very good example of how someone can be right on the money in terms of the idea and still lose money on the trade. There's a simplicity associated with the futures market that just doesn't exist over here in the options market. And again, there are some really smart folks out there who have really complex strategies and ideas and calculators and theories and whatnot. That's fine. I don't want to take anything away from anybody who's been very successful with futures options. But this is one of the reasons why we believe there are some distinct advantages in terms of simplicity to futures. And again, you're buying the low of this candle down here, about 35 or 36 points. Okay, the market rallies up, goes a little bit flat or down. The next day it comes down, you panic out of the trade, you end up taking a loss here. Over here, you're still in a significant winner of about 800 bucks on one contract. So, that's a regular size E-mini S&P that we're talking about. If you're trading the micros, these dollar amounts are going to be much smaller. If you're only trading one micro, we're only talking about $80 in this case. But we're not also suggesting that you necessarily put only one micro on. There are cases to be made, and I've demonstrated this in some of the other videos about scaling into positions using these micros. You don't have to be a hyper active scalper type day trader to be a really important customer at Infinity. Okay, these micro contracts allow people, in my opinion, to trade futures in a way that they kind of wish they could have traded the E-minis the first time they tried this if they could afford to take the risk. And now most people can. The overnight margin, maintenance margin on an E-mini S&P right now, or a micro E-mini S&P, is only about $630. That is affordable for the vast majority of people who want to do this in the first place. So again, I think this is a pretty good example because it shows how time value, psychology, and implied volatility can work against an option trader who had a pretty decent idea. And even if this option trader doesn't execute perfectly, if they execute that same idea, including maybe the negative, aspect of it, meaning kind of panicking out of something, in this example, the futures trader still wins and the option trader loses. So something to think about. Again, simplicity is really important to someone like me. I'm not a mathematician. I don't think most of my customers are. There are definitely some really neat things about the options world, but to me, simplicity is key, and it's one of the reasons why we believe futures, especially with the presence of these micros and the ability to trade on such a small scale and scale into positions, provides a distinct advantage over the options world. So hopefully you found that interesting. If you'd like to chat more about it, have ideas, comments or questions, definitely welcome that. We appreciate your time. Thank you.